A probability model just flashed a rare signal, over 93% odds that the Federal Reserve will cut rates this week. And yet the crypto market, especially XRP holders, may be walking straight into a moment far more complex than a simple bullish expectation. Because while everyone fixates on the cut itself, the real pivot might emerge from what Powell says afterward, the emotional read of his tone, and the collective exhaustion that's been building across Q4 of 2025. And that exhaustion, the market loves exploiting it. What we're exploring today is not just another FOMC update. It's the strange disconnect between expectation and reaction. Why previous cuts produce dips instead of pumps. Why XRP sits in one of the most psychologically tense zones of the year. And why a single phrase from Powell, optimistic or cautious, might trigger a market response that no probability chart has prepared you for. Before we go deeper, here's a quick challenge. If Powell comes out dovish on Wednesday, who leads the breakout, Bitcoin or XRP, and why? Not what you hope, but what you genuinely believe. Drop your answer now. Your comment might age better than half of Wall Street's forecasts. Now imagine this. Markets wait weeks for a rate decision. Traders look at their charts with anticipation, watching XRP slide under $2 to $1.98 before snapping back within minutes. Bitcoin bouncing around 90,000 amplifies every ripple across the market. None of that is random. That's compression. That's what happens when fear, exhaustion, and hope collide all at once. A fear index of 22 isn't a number, it's a mood. It's a community holding on by fingertips, expecting pain, even when the charts briefly smile. And yet, here's the twist. While everyone keeps refreshing CME's 86% probability and Polymarket's massive 93% confidence, the outcome isn't the story. The real story is that when something becomes too guaranteed, when traders think the result is obvious, the market stops reacting to the result itself. It reacts to the unexpected parts, the tone, the phrasing, the hesitation. Last time, Powell dropped a line that tanked enthusiasm instantly. They weren't forecasting cuts even though they had just delivered one. That contradiction crushed the market harder than the decision lifted it. Tone beats numbers. Every time. January being labeled a pause adds another layer of market psychology. Most people interpret a pause as calm, a reset, a fresh start. But markets don't care about calendars. Crypto especially does not wait for January to decide direction. What we actually get is a weird emotional lull. People relax too much, assume stability too easily, and misread setups because they're mentally preparing for a new year rally that might never come. The smartest traders treat January expectations as noise until liquidity shows a real trend. Look back at the last two cuts. You'd think cuts would be bullish, right? Lower rates mean easier liquidity, better discount models, theoretically greater appetite for risk assets. But what happened? Hope before the event, confusion during the event, and a drop right after. It wasn't the cut's fault. It was Powell's messaging around it. His tone made the market interpret the cuts as a sign of weakness, not strength. Traders didn't buy that. They sold it. Cuts didn't lift markets because the context contradicted the action, and context always wins. Now here we are again, watching the clock tick. 72 hours, then 48, then 24. Every countdown creates tension. Traders project meaning onto every tiny candle, hoping to catch the pre-FOMC pump that usually doesn't exist. Algorithms ramp up because engagement rises. Liquidity gets thinner, not thicker. Every small move feels massive because emotions are inflated during countdown windows. Countdowns create illusions, and illusions create traps. But if there's one thing that stands out this year, it's the emotional exhaustion of XRP holders. Q4 of 2025 has drained people. They're tired, they're frustrated, they're fed up with sideways price action, with dips after every positive headline, with promises that never seem to materialize fast enough. Some are quitting entirely, throwing in the towel, leaving comments saying, "Stop it, stop hyping it, nothing's happening." And while that sounds negative, it's actually the phase that often precedes larger moves. When emotion collapses, volatility drops. When volatility drops, accumulation begins. When accumulation begins quietly, future expansions grow louder. Exhaustion is often the final stage before acceleration. Meanwhile, there's a full-blown narrative war happening online. Rumors of a new Fed chair, secret Monday QE, surprise liquidity programs, none of it verified, none of it credible, all designed to farm clicks. That noise pollutes trader judgment. Reliable sources keep it simple. Rate decision, policy statement, Powell's conference. Everything else is engagement bait. Filtering hype is now a survival skill. And yet consensus itself may be the most dangerous part of this week. When both CME and Polymarket show overwhelming confidence, retail traders relax. They expect predictability. They assume outcomes. But markets punish complacency. If everyone expects a cut, the cut isn't the catalyst anymore. The press conference is. The interpretation is, certainty becomes a trap the moment it becomes universal. And that's exactly where we stand today. If you want coverage the moment Powell speaks, and a breakdown tailored to XRP holders, like the video, subscribe, and turn on notifications. The live reaction always reveals what the raw data doesn't. Now picture Powell stepping to the podium. If he delivers calmness, warmth, a hint of optimism, even subtly, that alone could spark a relief rally. Crypto craves reassurance more than it craves lower rates. But if his tone leans cautious or hawkish, volatility will slap the market instantly. XRP, which lives in a liquidity-fragile environment, responds faster to tone than to policy changes. Tone is the real catalyst. Plan for both directions because both remain viable. Two expert viewpoints highlight that perfectly. Tom Lee insists cuts should lift markets by reinforcing discount models. But macro strategists warn global liquidity remains tight, muting the effect. When you merge the two, you get a clearer picture. Cuts help long-term, but dovish communication helps now. That's why Powell's Q&A moves markets more than the official statement. Numbers inform, tone moves. Global markets also react instantly to a U.S. cut. Asia recalibrates, Europe adjusts. Emerging markets shift liquidity flows. XRP, connected to cross-border efficiency narratives, often responds quicker than Bitcoin to global liquidity pivots. Yet traders obsess only over U.S. numbers, ignoring the worldwide ripple effect, pun intended. And then there's Ripple's silence. No big announcements, no sudden media blitz, no attempt to distract from macro noise. That silence reads like confidence. Projects worried about short-term turbulence tend to overcommunicate. Projects with strong long-term positioning stay quiet, patient. Ripple's silence before a macro shock is almost a tell. They know their time isn't defined by FOMC weeks. Eventually, markets hit what I call the settlement singularity, a point where speed matters more than policy signals. Liquidity gaps widen, traditional rails lag, and assets that settle instantly rise in relevance whether Powell smiles, frowns, or stutters. XRP benefits inherently from that structural trend. Utility eventually outpaces narrative cycles. But here's where many traders go wrong during FOMC week. They mistake volatility for opportunity and load up on high leverage. That's not strategy, that's roulette. Meanwhile, long-term investors accumulate during fear, not excitement. Confusing noise for trend direction wipes out more accounts than bear markets ever will. Survival is a strategy in itself. On-chain data tells a calmer story. While sentiment screams panic, wallet activity and subtle accumulation continue rising quietly. This divergence is one of the market's most reliable signals. Emotions lie. Data whispers truth. Fear pushes people away, while patient investors quietly prepare. If Powell suggests structural easing, or even hints at prolonged accommodation, liquidity windows will reopen across the sector. XRP, caught between undervaluation and emotional fatigue, could absorb that shift far more aggressively than people expect. Liquidity changes everything. Not narratives, not predictions. Liquidity. And before Powell speaks, two opposite facts collide. Retail sentiment is at its lowest point of the year, and certainty of a rate cut is at its highest. These moments, when exhaustion meets confidence, almost always precede volatility shocks. Something moves, something breaks, something snaps. A shift is coming. The only question is direction. So here we stand, days away from the final macro shock of 2025. XRP isn't defined by price right now. It's defined by psychology. Fear at 22, fatigue everywhere, sentiment broken, expectations confused. Yet beneath the exhaustion lies compression. Beneath compression lies potential. The cut may already be priced in, but Powell's tone isn't. And that's where the real movement hides. Whether we pump or fall depends on sentences spoken into a microphone on Wednesday afternoon. Watch closely, stay patient, and be part of the 1% that sees opportunity where others see fatigue. Our next deep dive breaks down the 3 macro indicators that flip before XRP rallies. You won't want to miss that. Not professional advice, consult a qualified expert as needed.